2024 is right around the corner. It's an election year. We know that crazy things happen in an election year. Right now in the housing market, interest rates are running rampant. They're ridiculously high. It's causing houses to sit longer, which is making prices come down. So as we go into the new year, is real estate doomed or is it poised for a breakout year? What's up, guys? Real quick, if you haven't joined my free Facebook group, Residential Real Estate with Jaron Sustar yet, you need to scroll down to the show notes of this episode, click the link to the Facebook group. It's completely free, fantastic place to network and collaborate with other residential real estate investors all across the country so that you can continue to grow your real estate portfolio. To say that real estate has been a crazy roller coaster ride over the last 3 years would be a mild understatement. If we rewind all the way back to 2020, nobody was sure what was about to happen over the next 3 years. It was very uncertain times. The country's shutting down. People are skeptical. They're scared. The markets are turbulent for a short period. People don't know if we're about to go into a global collapse economically or if we're going to do the opposite, which is flourish. And that's what happened. From 2020 till 2023, the markets went on a huge bull run when you look at the stock market and when you look at real estate. And so whether you just owned your personal home or you're an investor like myself, it's been a fantastic run and it's added a lot of wealth to those who have real estate as an asset in their portfolio. But while real estate was going up in value, the government was printing more and more money through the stimulus checks. In case you didn't know, when the government prints money, especially the amounts of money that they printed in a short period of time, it leads to what we call inflation. And so what happens with inflation is the dollar starts to lose its value and everything else starts to go up in price. And so with that, interest rates have increased drastically in the last year and a half to 2 years. We were living in this utopia of 3 to 4% rates for a few years there, and that's just not normal. And to be honest, it's not very healthy for the economy. And if you talk to old timers who've been around a long time and understand economics, most of them will tell you that they've never experienced rates that low in their entire life. When you look back at what are average rates over the last 50 to 100 years, you're going to see that somewhere around 4.5 to 6.5% tends to be the norm, where you have a few outlier years when I think it was in the 70s with President Carter, where they had the ridiculous interest rates up in the 15, 16, and 17%. But for the majority of the time, we like to sit somewhere between that 4.5 to 6.5% range, which is healthy for the economy, but also allows investors and home buyers to be able to get into properties without their debt being too expensive. So problem number one was rates were too low anyway. Problem number two is the government is printing a ton of money in a short amount of time. And so the Fed said, we have to curb this inflation. What is one of the ways we do that? We increase interest rates. Now, usually they want to try and do that on a gradual scale, which they would say they did, but I beg to differ because we went from getting 2.9% interest rates on properties to now getting 8% interest rates on properties in less than a 2-year span. And that is pretty darn quick to make that big of a jump. And because of that, the consumers have suffered. I'm reading an example here that if you were to buy a $450,000 home in 2020, your payment was going to be $1,925 if you had a 3% interest rate. But if you were to buy that same property with a 7% rate today, your payment is going to go up $1,000 and be $2,923 per month. So what does that mean for the average person? Well, quite simply, they can't afford the same home that they could a couple years ago because the debt to own that home has become so expensive. And to make matters worse, we have around a $6.5 million home shortage in the United States. So then when you mix in that basic economic principle of supply and demand, supply being very low, causing high demand, that only adds fuel to the fire to push prices even higher. And so we've seen this wild run over the last few years that has now come to almost a screeching halt because of the cost of debt on properties. And so the days of properties being listed and getting under contract within 2 to 3 days because the buyer could get 2 to 3% interest has changed to now homes are sitting on the market for 30, 40, 50, 60 plus days. Well, what happens when homes start to sit on the market for a longer amount of time. Prices have to come down because the sellers realize I'm not able to get what I thought was top dollar. That top dollar has now dropped significantly because although there's still a supply shortage, these artificially increased rates have slowed the buyers down significantly. So you're thinking, great, Jaron, you've just recapped what happened between 2020 and 2023. Tell us what 2024 is going to look like. I'm so glad you asked. Here is my opinion of what real estate is going to look like in 2024. It is an election year, as I previously mentioned. When a sitting president is in his first term, they are going to want to do everything within their power to be elected in that second term. And so what I think is going to happen is you're going to see rates start to come down because that is going to be a big factor at the voting booths. People are having trouble affording housing. They're having trouble affording the cost of goods. Think about it. You can look at any news outlet. You can hop on any social media platform. And one of the main topics that is trending all the time is the price of houses and the cost of debt to be able to obtain those houses. And so as we grow closer to the election in 2024, I think we are going to see rates start to go back down. People were scared of 5 or 6% interest rates on the climb up because you have to remember they were used to seeing 2%, 3%, 4% that they were quoted. But now we've been sitting in this 7, 8, 9% market. And so when we drop back down to 5 or 6% in 2024, that 5 or 6% is going to look pretty darn good. And more importantly than it just looking good on paper, it is going to make housing more affordable because debt is going to be cheaper, which is going to lower the monthly mortgage payment for these buyers. If you've been struggling finding good real estate deals, I've got a solution for you. It's REI Call Center. REI Call Center has professionally trained and managed cold callers to help you scale your real estate business. I think they give you somewhere around like 1,500 cold calls per day. Their clients have closed around $10 million from the leads they brought in. They got close to 200 clients going right now, and they're really more than just cold callers. Yes, they have their team of professionals who are making their calls, but they have weekly trainings and Q&A calls for yourself. They have training videos. They've got Slack channels with dedicated people to make sure you're successful. They've got checklists, cheat sheets, you name it. They've got you covered to make sure you are successful in your real estate journey. Well, how does it all work? Well, step one, you're going to pull a targeted list working with them from prop streams so that you can target the certain locations that you want to start buying properties in. Second, they're going to use their Zen call platform to start calling 1,500 calls a day per cold caller. They're going to then upload all the leads into Asana. You have a view of them and you can go attack and start buying the properties that you see that pique your interest without having to do any other work. Look, I have worked a W-2 job while building my real estate portfolio. I've been raising a family the entire time, so I haven't had time to go and cold call myself. And that's where a company like REI Call Center comes into effect to be able to take that load off your plate so that you can generate leads, close more deals, and build that portfolio. You can reach out to them at reicallcenter.com, or if you go to the show notes of this episode, you will see a link that will take you directly to them. Now, we already know that there is a huge shortage of homes in America. So we have low supply. At the core of all basic economics is supply and demand. And so we know when there is a low supply, demand is going to be high. Now, demand is being tampered right now, as we talked about, because there are artificially high rates. But imagine what's going to happen when those rates go from 8% down to 5 or 6%, and we still have that low supply shortage. I think real estate is going to absolutely skyrocket. Think about it. You got prices starting to lower right now because people aren't buying because they're scared of the rates because they're so high. So housing is getting more affordable from a price standpoint. When that affordability in 2024 is paired up with lower interest rates, there is going to be a buying frenzy. And when that buying frenzy happens, if you look back to what was going on in 21 and 2022, housing prices are going to jump again. So if you own a personal home, great. You're probably going to make some pretty darn good money over the next 2 to 3 years. But I want you guys to imagine what life would be like over the next 2 to 3 years if you own 5 additional rental properties or 10 additional rental properties or 15, 20, 25, 30, you name it. You are going to be able to take advantage of strong appreciation in a short amount of time. And so what I'm doing doing to prepare for the next 2 to 3 years is, while the market is slow right now and there's not as much competition because people are so short-sighted and are not buying just because rates are high today, I'm going in, getting homes at a discount, getting them rented out, knowing that my cash flow isn't going to be as high today because rates are higher, but playing the long game. I'm zooming out and looking at if I can buy undervalued today. For example, there's a property that was listed for $150,000 on Zillow. I closed on it for $105,000 2 weeks ago. So I got it literally $45,000 under asking, and this was a listed property on Zillow. After repair value, so what it's gonna be worth after I fix it up, is $250 grand. So I'm gonna buy it at 105. By the time I'm done rehabbing, I'll probably be all in the property at 150 grand. It's now gonna be worth 250 grand because of the rehab I've done. And so instantly I have $100,000 in equity today. Is my cash flow crushing it? Absolutely not, because rates are high and I executed what's called the Burr method. But I have $100,000 equity sitting today. But when rates start to come down and that housing market picks up again and people start buying left and right because the newbies only buy when there's good rates, what do you think is gonna happen to my equity in that particular property? My bet is that it's gonna go from having $100,000 in equity today to having 125, 150, $200,000 in equity. And guys and gals, that is how wealth is built. And people say, well, what if that doesn't happen, Jaron? What if you're wrong about 2024? Big whoop. I have fixed debt. I am cash flowing, although it's not as high as the cash flow would be if I was at a 4% rate. I'm still cash flowing, and I've given myself a buffer of $100,000 worth of equity. And so if housing prices were to drop drastically, let's say we had a 20% drop in the price of homes, a house that I just told you about would go from being worth $250,000 to now only being worth $200,000. Well, what am I all in that property for? I'm all in at 150. So I still have this buffer of $50,000 worth of equity. So if I had to sell it, there's still meat on the bone. But I'm not going to have to because I bought well. It's still cash flowing, and so I'm going to hold for the long term. And eventually, based on data, based on history and past performance, real estate will go back up. And as it continues to go back up, my net worth in that particular property will grow as well. And if you don't believe what I'm saying, check the data. This graph shows you that since 1942, real estate has either stayed the same in value or gone down in value only 7 times. 7 times since 1942. That means all of the other years, it's gone up in value. I think we all lived through the recession in 08 and 09, and so we live with this fear that we expect it to happen again. We're waiting every year. When I started buying in 2018, terrible time to buy real estate. 2019, terrible time to buy real estate. 2020, terrible time to buy real estate. The market's gonna crash, the market's gonna crash, the market's gonna crash. You gotta stop living like that. Data tells us that we have a pretty good chance that it's not going to. When you look at 08 and 09, that happened because of bad lending. We don't have bad lending practices today. But even then, if you buy good in good areas, and you have equity from the purchase and cash flow starting at the purchase, then you can weather that storm when it comes and come out the other side doing A-okay. And so here's what I would tell you to do today to prepare for the next few years. Stop letting rates deter you from buying investment real estate and start adding properties to your portfolio. There are deals to be found. They are everywhere. They are plentiful. Go lock them up. Undervalued, leave yourself a buffer with good equity, cash flow, knowing that that cash flow has the potential to get better over time as, number one, rates go down, but then number two, as rents increase. Because if we look at rents over the last 100 years, they've either stayed the same or increased. Rents do not go down, and they tend to double every 10 years. And so it's like the old adage says, don't try and time the market, worry about time in the market. Hardly ever do all the perfect metrics line up where rents are where they need to be and mortgage rates are where they need to be and home prices are where they need to be. Those three metrics hardly ever all are working at the same time. There's usually one outlier that's making it harder for investors to be successful. And so if you plan on being a successful long-term investor, you have to learn to curate deals without all three of those metrics being perfect. And the ones who can do that are the ones who become overnight successes and get lucky because they bought at the right time. And so I'll leave you with this. If you haven't started investing in real estate yet, or you have a few properties and you just haven't been able to scale yet, myself and our team want to help you. We coach hundreds of people to be able to add rental properties to their portfolio, as well as do fix and flips to generate income so that they can change their life and their family tree. There's a link down in the show notes that you can click on to schedule a time to chat with us. We'll tell you more about it and how we can get you started and help you buy your first or next property within the next 90 days. Thank you so much for watching this video. I'd greatly appreciate it if you would like this particular video, and then also subscribe to the channel. It'll notify you when we release new content so that we can keep you educated with what's going on in the real estate space. I love you guys. Thank you for supporting, and I'll see you next time.